to the special edition of Global Mantra Outlook 2013, a special show that profiles prominent fund managers from the City of London and gets their views on the global market environment. Joining me on the show right now is Mr. Ewen Watt, who is the Chief Investment Strategist at the Blackrock Investment Institute. Mr. Watt, thanks very much for taking out the time.
Tanvi, welcome to our office.
Oh yes, and this is your first interview to an Indian business channel, so we appreciate it.
And it's a great privilege.
How would you look at the European situation for 2013?
I think as far as the Eurozone economy is concerned in 2013, it's going to be fairly depressed, particularly in the first half of the year. I think that you cannot be anything other than cautious about the outlook for European growth, with governments trying to cut their fiscal deficits and with European banks still seeking to shrink their balance sheets. And such growth as there will be will result, I suspect, from the external side of Europe, so non-European demand as seen through the trade account.
Do you think that austerity will be the new norm, that governments across the Euro region will be forced at some point in time, and I don't know whether that will happen in 2013, you'll have to throw more perspective on that, but they'll be in a situation where they'll say, our balance sheets are getting way too risky, and we need to put in some hard measures, whether it comes in terms of tax hikes or spending cuts. And that includes the stronger nations like Germany and France as well.
Well, I think it varies across the Eurozone. In France, for example, there's a fiscal consolidation planned, but it's much more because they expect revenues to rise than expenditure programs to drop. Okay. So the outcome's got to be very linked in an almost circular way to how strongly France grows or not, because consumption is always taxed more heavily than savings. In Germany, next year, election year, in the autumn, I would expect there to be some mild stimulus through cuts in taxation as the run-in towards that election. In southern Europe, I think what will happen is that we've already seen a complete collapse in domestic demand in a number of the southern European countries. We're going through a front-end loaded, that is to say it's happening right now, fiscal austerity program with revenues rising and social programs being cut. The impact is bound to be its most acute while that is happening. Okay. The structural reforms that go with that will be tremendously important, and there's great progress being made, particularly in Italy, and to some extent, to be fair, in Spain as well. By about 2015, 2016, I would expect that we'd be beginning to see some pronounced upswing in Europe. It's probably as bad as it gets around now because of just the confluence of events.
So do you think we've seen the worst?
Look, I think when you go from an expanding economy to a severe contraction in credit, that journey is very, very painful. Okay. I don't think we're about to see a big U-turn, and a lot depends on the policy mix, particularly that adopted by the European Central Bank. But I think what the ECB has done is it has reduced to a fairly low level the risk that European banks would have a fire sale of assets and there'd be forced deleveraging because of funding problems, which would then lead to a solvency crisis.
So where does that leave the euro as a currency?
If an economy runs a current account surplus, it doesn't need to import capital to fund it. And on Indian television, everyone should understand that. There's therefore actually a shortage of euros because the Eurozone as a whole runs a current account surplus, and that current account surplus has risen rather than declined because of the reduction in activity in southern Europe.
So do you expect the euro to get stronger from here?
The example of Japan since 1990 tells you that in a slow economy with a current account surplus and when the domestic citizens are prepared to hold the domestic currency, it tends to strengthen relative to currencies which require capital inflow or where the governments are printing lots of money.
So if I were to just sum up 2013, the risk in Europe you think would be more measured?
It's growth. We've swapped in Europe systemic risk for growth risk. The gap between winners and losers in European stock markets has been considerable, which is why many European fund managers, including, I'm glad to say, my own colleagues, have produced such excellent absolute and relative performance.
Part of the reason why the Indian market did well this year was attributed to the euro concerns settling down a bit. So for 2013, for all the Indian viewers watching us right now, you don't think that the euro will, or the eurozone will spring any surprises, negative surprises, so to speak?
I think the surprises are not going to be pleasant ones, but I don't think they're going to be acutely unpleasant. I think the idea that Europe's in a period of austerity really isn't front-page news anymore. I think the issue is just the longer-term one of how long it takes to go through some of these many painful reforms, and how responsive the electorate are to the requirements to be, to have their standard of living declining consistently.
All right, Mr. Watt, we'll take a break on that now, but when we come back, we will discuss the other key risk that the market will be watching out for, and that comes in from the U.S. economy. How is that positioned for 2013? We'll discuss that with Mr. Watt in just a bit. Stay tuned.
Politicians in the United States will agree with each other before the half year. They will agree in a way which will help people's appetite for risk rise rather than fall.
Welcome back. You're watching Global Mantra Outlook 2013, and I'm still in conversation with Mr. Ewen Cameron Watt from the Blackrock Investment Institute. Mr. Watt, let's talk about the U.S. and all this hype about the fiscal cliff and how it's going to be dealt with.
Yeah.
What is the worst-case scenario?
The worst-case scenario is the politicians are still scrapping with each other by the middle of next year, and that no agreement can be reached. There's a lot of really good stuff happening in the U.S. economy. Okay. The housing market has clearly picked up. Yes. The shale oil revolution has improved the competitiveness enormously. There's been an upsurge in foreign direct investment into the United States. The banking system has cleaned itself up to a significant extent. Provided that the politicians can swallow their disagreements and reach some kind of agreement, and it'll be an agreement that's also not just about the fiscal cliff, but it'll be about budgetary reform. If we can get some way towards something plausible in that sense, the United States will be the strongest performing G7 economy over the next 24 months. But that has to happen. The fiscal cliff and the disagreement of the politicians, in a sense, has to be dealt with, and we're just exiting from a very bitter election. The optimist in me says that businessmen, the financial sector have told the politicians very loudly, very clearly, that the risk they're taking is of creating a recession unnecessarily, and that risk really will be focusing their minds.
Okay, what will be the impact of, how the fiscal cliff is dealt with on the markets?
If we have a fiscal contraction, and there will be a fiscal contraction, there will be some tightening of the fiscal stance. If we have some tightening of the fiscal stance of, say, 1 to 2% over the next 2 years, which is what I might be thinking about, and some taxes are raised, like dividend taxes, and some programs are cut, and the entitlement age goes up, I think the stock market will treat that very positively. And the reason they'll treat it very positively is that if businesses have got clarity on which to plan, they will do so. They will step up capital investment in the United States. That will increase employment. But the Federal Reserve will still be running a very supportive monetary policy until unemployment gets down to well below 6%. So you'd have the environment of an accelerating economy and a very supportive monetary policy, and I cannot but see that would be good for American equities.
What about EM equities? What about emerging markets? What do they take away from this risk?
The issue for emerging market equities is a little bit more subtle, and it's to do, I say, with the value of the dollar. In an environment where the US hits a fiscal cliff and the economy contracts, I think actually the unexpected thing would be the dollar would strengthen. Because under that circumstance, America's economy would be shrinking and the current account deficit would be lower. And the current account deficit is the means by which Dollars are exported to the rest of the world to be used in trade and whatever. So a smaller current account deficit in a contracting economy might well equal a stronger dollar. The stronger dollar would be harmful to emerging economies because that would be a tightening of their financing and monetary conditions. So if I was an Indian businessman or a Chinese businessman or whatever, I'd be very keen to see a situation where the fiscal cliff was solved, because I would view that as being positive for the business environment, the financing environment and the investment environment in my country.
Right. Aside of the strength in the dollar, what do you think will happen with the U.S. Treasuries, that market? Because, again, it's a crowded trade despite yields being at record lows.
Yeah.
How will that pan out?
Well, regulation has an important part to play here. I mean, the pension fund industry in the United States, the banking sector, the insurance sector, regulated investors are in a sense being forced by this process called financial repression into buying bond assets. Yes. They're being forced to buy them because they are low volatility or guaranteed cash flows. They're buying them when the chances of making a real return out of a lot of it are as close to zero as I've ever seen. So that said, because regulation, the aftermath of the financial crisis is that governments understandably want savings organizations or banks or insurers, people with financial products, they want them to be less volatile than they were before. They don't want that risk again. Also at the same time, there are substantial deficits, government deficits. So pretty much anywhere you look in the developed world, there's an effort to force people into buying bond assets, substantial deficits, government deficits. So pretty much anywhere you look in the developed world, there's an effort to force people into buying bond assets, irrespective of the potential return, for regulatory and political reasons.
If I were to just break this down and look at your view of 2013 as we start of the year, where, depending on the scenario that you think would play out on the fiscal cliff, how do you think money would flow?
I think it comes down to policy. As an optimist, I'm going to take the view that, generally speaking, the politicians in the United States will agree with each other before the half year. They will agree in a way which will help people's appetite for risk rise rather than fall. That interest rates will remain at zero because of employment consequences. And at Blackrock, we've taken the view that the longer that you stay in cash, the more harmful that is to the growth in your savings that you need for retirement. The number of elderly people is rising. They need savings. They need income, which is one reason why income-based strategies have been so popular, because people are getting that. But there's a lot of cash sitting on the sidelines, and that cash will gradually come to work in riskier assets if the regulatory environment's clearer, the tax environment's a bit clearer, and people can measure the risks.
So you think emerging market equities, emerging market debt would be the place?
I'm optimistic about emerging market debt. Emerging market equities, and that's a structural optimism, emerging market equities, I think provided that the optimistic outlook comes along, then I think they should do reasonably well, because people still want to be exposed to the faster growing parts of the world.
Fair enough. What about commodities, especially gold?
I think gold is okay for now, but an awful lot of people have bought gold as a hedge against governments printing money and interest rates being zero forever. So therefore, if you get to a point in the cycle, and maybe it's a 2014 point, but you get to a point in the cycle where people become more confident about economic activity, the gold price is vulnerable, and the other way around, it's not.
How do you see oil being a trigger for really emerging markets, especially a market like India?
Well, see, I don't share the view that oil is going to be weak for a long period of time, and I think that the supply side dynamics of the oil industry are severely challenged, whether it be because of aging wells, whether it be because of political tension. Now, of course, there's the shale oil revolution, which is a very important point. But there's still a transition period because it's only really the United States and Mexico and maybe Poland that are really prepared at the moment to exploit shale oil that actively. I'd say the supply side for oil is still pretty finely balanced, and it doesn't take much for it to decline. And if the Chinese economy is accelerating a little bit more next year, car sales are projected to be up there by 6, 7, 8%, having been flat for the last couple of years. I'm not sure that I'd project the oil price to drop a lot.
Okay. Mr. Watt, we'll talk a lot about the opportunity that you see in emerging market equities and in emerging market debt after this very short break. Stay tuned to Global Mantra.
I know you'd like me to say India, wouldn't you?
I would love you to say India.
I think that emerging markets have shown themselves increasingly to be driven by what's happening in China. The Chinese economy is going to be growing at a slightly faster rate.
Welcome back. You're watching Global Mantra Outlook 2013, and we're still in conversation with Mr. Ewen Watt from Blackrock. Mr. Watt, let's talk about emerging market equities. I was reading one of your articles, and that said that currency is a preferred trade that you like in emerging markets, aside of equities and debt. How do you play the currency risk in emerging markets?
Well, I think that we used to start off by saying that as a foreign investor in an emerging market, usually it's very difficult to hedge your currency risk. Not all the time, but usually it is because the interest rate differential is there. And so as an investor, you, I think, need to be aware of the value of the currency. And if a currency is very oversold, I mean, look, the Indian rupee got down to nearly 60 to the dollar earlier this year. That is a very attractive investment in itself, because it probably means that capital's flowed out of the country. It probably means that underlying assets are cheap. It probably means the government is actually going to be, the government of the country in question is going to be more welcoming to foreign investors at that stage. So I have always thought, in 25 years of investing in emerging markets, that you start off with an evaluation of the currency and the degree to which it's cheap or expensive. If you're buying emerging market local currency bonds, in general, again India is an exception to this, but in general they tend to have very short duration. They tend to be 1 to 2 to 3 year bond curves. And so by definition you're taking a currency view. Okay. So currency is the key that unlocks the door, is how I put it, for emerging market investing.
Stepping into 2013, which are your favorite emerging markets?
I know you'd like me to say India, wouldn't you?
I would love you to say India.
I think that emerging markets have shown themselves increasingly to be driven by what's happening in China, particularly the Asian markets. And I think the Chinese economy, about which more nonsense has been written than pretty much any subject in the world, the Chinese economy is going to be growing at a slightly faster rate.
Do you think that will be reflected in the market's performance, because China as a market has underperformed?
China as a market has underperformed, and that's partly been because the slowdown in the economy has been accompanied by a considerable tightening in domestic financial conditions. So company profits in China have been hugely hit in 2012 by a squeeze on profit margins. That in turn has squeezed their cash flows, and that in turn has squeezed the stock market. Now I think it's more about, let's suppose that next year, Chinese growth is going to slow down over time. I think that's almost certain. Apart from anything else, China can't feed itself now. Here is the second largest economy in the world, the most populous economy in the world, which has to import food. I don't think I can think of a modern example of that, which hasn't had vulnerabilities then in that economy. I think that as I look at 2013, China's appetite for commodities generally is going to remain quite strong.
How do you kind of view India's performance on the back of what's happened in 2012, with the market going up 20% plus?
Well, we still believe there's lots of long-term attractiveness about Indian companies, whether it be that they earn relatively high returns on capital because of supply-side issues as much as anything else, whether it's because they tend to be run in a fairly transparent and open way, or whether it's because the starting valuation, 13 times 2004 March 2014 earnings, whether that's an attractive enough valuation. It's certainly not expensive by its own history. I think we would see politics as being tremendously important. It always has been in India, it always will be. And by the middle of 2013, I would expect that the reform process, which is being talked about now, will be starting to slow down because people will be taking positions, starting to look forward to the 2014 election. And we know, and it's not a uniquely Indian circumstance, we know, as we've seen in the United States this year, that the onset of an election tends to paralyze the decision-making process. And India doesn't need much to its decision-making process and politics to get paralyzed. As things stand at the moment, presuming the fiscal cliff is solved, and presuming that the US dollar doesn't then strengthen very much, I could be reasonably comfortable that the RBI is going to be easing rates a little bit. It doesn't have much room, but a little bit, and that under that circumstance, foreign FII activity would be still reasonably positive. The supply in terms of new listings is not that great because companies are saving cash now, and that would help the market.
India is trading at 15 times forward earnings, which is, as per its historical average, fair value for the market. Do you expect that to change in 2013 from a valuation perspective?
I don't see why it should be valued a great deal higher than that. Generally speaking, global valuations for equities have been pushed down a bit. I think that if you get a lot of risk appetite, which I don't expect, I expect it to be an improvement, but if you had a lot of risk appetite, then maybe. But really for the Indian market to rise in PE terms, domestic Indian investors have to be purchasing equities as well as foreigners, and they're not doing that at the moment. Domestic investors sold $8 billion of equities this year.
What's your view on the Indian rupee as well as the Indian bond market, which hasn't really seen the kind of inflows that it could have?
Well, the Indian rupee is, I think, probably a little bit undervalued, but I think it remains so until you get to a period where, again, people are prepared to take lots of risk globally, because India is still funding its current account deficit through short-term portfolio flows, and it's very noticeable that Indian companies exported quite a lot of capital in 2012. And, if the Indian economy is as great an opportunity as everyone hopes it's going to be, you've got to wonder why leading Indian companies export capital.
One last question that I have from you is that, you had mentioned in one of your reports that India is at a crossroad. The elephant is sick. What is it that you really expect 2013 to do for India as a market and as an economy?
Over many years, I've come to expect that the pace of reform in India is directly linked to the acuteness of a crisis.
Okay.
And that's not surprising. I mean, it's a huge democracy with lots of competing regional and equality issues. One shouldn't be critical of that at all. It's a natural circumstance for a country like yours. So I would think in 2013 we'll see some slow progress in terms of reform. I'd like to feel that some of the infrastructure projects get accelerated a little bit. I'd like to feel that some of the foreign direct investment activity that's been talked about is actually allowed. But I don't see the crisis as acute as it was in 1991 for there to be widespread acceleration. And as I say, towards the end of the year, I expect the politics, or rather the forward-looking towards the election, will start to play a role.
Almost upgrading India to an overweight stance, where right now funds are a bit skeptical?
The answer lies a bit more within India itself and with the confidence of Indian investors. And interest rates play an important role there. I think that you've got to see interest rates coming down. You've got to see the domestic investor becoming more confident that they're being looked after properly, not by the fund managers, but by government and by regulation. And my sense is there's a little bit of a way to go on that.
Will that also mean more trips from you to India in 2013?
I'd love to come and visit you.
Okay, thank you so very much, Mr. Wolf, for taking out the time and speaking with us.
Our pleasure.
Well, with that, we come to the end of this edition of Global Mantra Outlook 2013. Catch you again next week with another special guest.
Indian holdings at the moment are limited to banks, where we've done very, very well indeed. We are a stock-picking, bottom-up oriented fund that has on aggregate 70 holdings globally. We've chosen to take consumer exposure elsewhere, and we've done well out of that. If you were to look at the staples category globally, the re-rating has happened everywhere.